Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets influenced by the same. I'm flying solo today, missing my buds, Miles and Robert, greatly. I am going to do my best, however, to plagiarize their charts and information they've provided for this week's show and let you know kind of what's going on, not just precious metals-wise, but the underlying fundamentals. So without further ado, starting with gold, Miles has put together some great charts here, and I specifically was hoping to shed some light on short-term versus intermediate term in terms of the charts, because it's an important differentiation. When we talk about Fibonacci support and resistance levels and these key lines in the sand, if you will, it really helps you to understand if we're looking in the very short term, here's a projected number. If we're looking a little bit longer term, we will avoid the real long term today, but if we're looking a little bit longer into the intermediate term, then we can see that that number can sometimes line up or be a completely different figure. So the beginning of the short term in gold, we're calling the March 2020 bottom. Okay, the beginning of the medium term would be May of 2019 before we had that major push up. So looking at the short term here at that March 2020 bottom and where we've retraced to, there's a lot of frustration by the gold holder, the gold bug, if you will, as to why gold isn't a little bit stronger. And we'll get into some of those, again, underlying fundamental reasons as to why. But what should we expect in terms of this pullback? The fact that back in July and August, we initiated this decline, and we did see that 1680 mark that's serving as that short-term 618 fib. Well, you should expect some resistance as you get up to the 1770 mark, which was the previous 50% retracement line. That's right where we are right now as we record today. And that 1763 is showing to be an area of a little bit of a stall. We are up about $20 today from the low. We started at around 1745 at the open of the New York market. And to be at 1765 is in the right direction. If we close above that and we can stay above that, then you're probably looking for that run above the 1800. And we'll get further clarity from Miles again on that next week. Now, looking at the intermediate or the medium term, what we're really looking at there is that's the 382 fib. So again, a key support and resistance level, both to the upside and the downside in either one of those trends, those periods. Switching over to silver, similar action today. We saw a low of 22.19, a high of 22.68. The reason I mention those numbers, that's about where we've been for the week. Not a whole lot of change. In fact, in the course of the week, the ratios have come down a little bit, which means gold has done a little bit better than silver. Silver's pullback was a little bit stronger. We talked last week about that gold to silver ratio being at 80-1 and not expecting it to hold because, one, the fundamentals had not changed, and two, you had not yet seen the initiation of a rollover in the equities markets. They've been trying, but I'll get a little bit into that here in a bit. So looking at silver on the short term, you've got the 21.37 was the low that we put in, and that's something that ended up not holding. It bounced back up above that short-term 618 fib number, and we're at 22.63 as I record, and we need to stay above that $21.95, $22 range there in order to be feeling good about that. If you look at this chart, however, because we dipped below it the one time, and we haven't seen a significant rally since, it's okay for it to see it come down to that 786 fib down around the $20 mark, because that's not only the short-term fib, it's also a 618 medium-term fib. So right around that $20 mark, don't lose any sleep if we see it. Just continue to buy as everybody's doing. We're starting to see premiums come back up because the physical demand is so high. But up to the upside, we really need to see us crossing the $23 threshold, approaching that 24, where you're going to see some key resistance. So there's a good chance we could bounce between that 21.95 and that 23.86 or so on silver. All right, as far as platinum, we can't forget platinum. The trend there is not very friendly looking ever since coming off around the 1340 high in March of this year. It's had this steady decline down. The short term 786 fib. Now for the short term with platinum, we're going to call that November of 2020 as a start, which is technically when it started to break out into that bull market. March of 2020, looking back with a little bit of retrospection, we could see that that was the medium-term initiation. All that to be said, again, right here at around 963 where we've been hovering, you've got two corresponding Fibonacci numbers. So the way Miles likes to chart these things is with the short-term 786 and then the medium-term 50% retracement line. Very healthy area to expect a stall here and almost magnetic pull. Hopefully we're ending up here starting to see a little bit of a bounce when the white metals turn. My only concern with the white metals is if we get an equities market rollover, you're likely to see silver come down towards that 20 mark, in my opinion, and platinum come down below that 900 mark, because the white metals will follow the equities markets if it's a strong enough move down, especially if it's corresponding with a dollar rally. That tends to be the case. Don't get surprised by that. You can look back at 2008. You can look back at 2020. The last two times that's happened when silver took that initial dip with the equities markets. When you see them corresponding like that, the white metals will lead the charge back up. They will outperform gold. And so really load yourself heavily in those opportunities as they present. So why is some of this occurring? We've talked on the show a little bit. A lot of people asking, okay, we've got inflation. We've got this flooding in the monetary system of U.S. dollars. Why are the metals weak? The two primary reasons is you are witnessing this treasury yield climb. We're flat on the week, about 1.52% on the 10-year yield, which is about where we were last week, and gold is about where we were last week. But the other thing you have is the U.S. dollar index. We did see some weakness. We came down to 93.6, giving up almost a full point from the 94.5 on the U.S. dollar index. But it reversed and it went right back up. Now we're at 94.22, up a quarter point today. And that's mostly because of the euro woes. Europe is having a lot of issues with inflation as well. They've lagged the American inflationary markets. They're witnessing a ton of pressure in the energy sector. Natural gas has more than doubled in the last 4 weeks. Gas prices are spiking. We're seeing it here, obviously, with oil just about touching $80 a barrel. So the inflationary fundamentals are still in the markets. In fact, the second quarter 2021 GDP inflation held at a 40-year high. Now, they're talking about August CPI inflation notched a little bit lower to 5.3% from its 5.4% 13-year peak. But if you follow John Williams from Shadow Stats, that actually corresponds to a 41-year peak of 13.4%. And here's what's important for you to realize. If you're sitting in cash, it's robbing you. It is a hidden theft, and it's decimating your savings. There are so many better ways to park into real assets where you're immune to this hidden theft. They want the dollar weaker. The sheer magnitude of debt that they've already entered into, much less talking about adding to, is something that's going to be here to stay for a while, and the inflation's going to continue. That hidden theft, that hidden tax is going to continue to strain your not only monthly and annual budgets, but it's going to decimate your savings. So that's where gold and silver come in. If you haven't moved your IRA and protected it yet, you've got to call us and talk about the logistics, the fundamental reasons for why, the specific strategies associated with that, because we can really help that be an active holding. But it's really time, and very well thought out, planned money is moving over in droves in IRAs for a very fundamental reason. And that is also the monetary supply. So the monetary supply is up 96.1%, which is a record. And that's 96.1% from the pre-pandemic trough. So this is not from a year ago post-COVID. This is from pre-pandemic. So correspond that money supply, of course, is going to flood the market and drive the equities markets. But I'm going to throw up another image here and show you what the source of the rally in the stock market has been since 2009. That's buybacks. It's corporate share buybacks. David and Kevin have spoken a lot about this on the McAlvany Weekly Commentary. But look at this chart and let this sink in for a second, because what happens when corporations can no longer afford to borrow at low rates and they have to start servicing their debt in other ways? But they're borrowing, they're buying back their own shares, they're driving up their share prices and giving this false bubble. Well, it's a real bubble, but it's a false sense of hope in share prices in the equities markets, long overdue for a downturn. And I'm telling you, you're sensing it. I'm sensing it. We're all sensing it here. That it's now. It is initiated. It is beginning. And the debt ceiling discussion, by October 18th, they're going to probably figure something out. That's when Janet Yellen says, look, that's when the emergency funds really run out, and you're going to have a hard time meeting the federal government debt obligations. They kicked the shutdown, in a sense, to December 3rd. But what they cannot pass is this huge spending. I think people are starting to see the writing on the wall. You can't just ask for $4.7 trillion because you don't have a debt ceiling. So something's got to give here. And when they don't get their wish and reality starts to set in, I think that you'll realize that's the top. The Federal Reserve is talking about beginning tapering before the end of the year, and they're discussing raising interest rates in December of 2022. So just that talk alone is causing a little bit of a stall. Remember, the last time they started tapering under the Trump administration, it had really negative economic impact, and it really negatively affected the equities markets that almost technically touched a bear market retracement. So circling all the way back around to gold, remember what it does, what its role is in your portfolio. Yes, it's a hedge, but it also boosts portfolio performance over the long term. There's going to be some bullish fundamentals in the precious metals markets. They're already forming. Even Bloomberg says that gold is going to revisit its peak soon. Well, that's $300 higher. And silver's going to follow suit, and not only will it follow suit, it'll outpace. So be encouraged. Don't be discouraged because of this recent pullback. Add the ounces as you can. Keep your eye on the ball. Don't let them distract you. And do remember that there are other things other than monetary supply and inflation that move gold. Geopolitical and political uncertainty certainly move gold. The treasury market and interest rates climbing outside of their control certainly drive up gold. A declining dollar drives up gold, not just from inflationary prices due to supply chain constraints, but due to a global psychological concern of the U.S. dollar and our treasury market, the ability to not only go deeply into debt, but an inability to fund that debt. So again, remain encouraged. Appreciate you returning and listening to the show this week. If you like what you've heard, make sure to follow us on Twitter at ICA Gold and subscribe to this podcast by clicking the subscribe button below the video. You can also like us on Facebook at McIlvaney Financial or go to our website, McIlvaney.com. As always, we would prefer to speak with you on the phone and be able to walk you through a total portfolio analysis. You can call us at 800-525-9556. Love to have the chance to spend some time with you. Thanks again for listening. Tune in next week when the whole gang is here.